I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of InkResearch.ca, Canada's first online financial news and research service. His website, CanadianInsider.com. Welcome back to the show, Ted.
Oh, it's good to be back, Jim.
What are U.S. insiders trading right now?
Well, right now, U.S. insiders are basically content to sell the rallies and also sell the dips. You know, they've been doing that now for most of the year. They're quite content to be selling these rallies, whether it's based on hope or any kind of one-off earnings type of news. In fact, we see about 10 stocks with key insiders selling in the U.S. for every 3 with buying. So that's a pretty depressed level, and it's indicating that insiders think that there's quite a bit of risk out there in relation to the price of stocks. So they're very conservative investors. They only tend to buy when they think things are undervalued, and of course, after years of central bank intervention, there's very few value opportunities left in the market. So that's, part of the story. Certainly, if you've been a value investor for the past 8 years, you know what I'm talking about. It's just very hard to participate in this market. You just have to hold your nose and kind of, buy something maybe with with whatever best appeals to you, whether it's a high yield or, a PE ratio that's not completely out of this world. I'm not recommending those metrics as an investment strategy, but the point is that it's been very hard to find value, and insiders are confirming that that has not changed, that we're still in a central bank inflated market that is where the risks are rising and the rewards are not rising as fast.
Are people looking for dividends instead of just the value of the stock?
Well, it's interesting. Dividends really depend on the attractiveness of dividends, I should say, in the eyes of the typical investor will depend on what's going on in the bond market. If bond yields are very low, then dividend stocks will be more competitive with those bond yields. So investors will be more inclined to go to dividend stocks. Okay, that being said, how are insiders playing this? Well, they're hedging their bets. Basically, we see within the energy sector, for example, that's quite economy sensitive, but also obviously sensitive to the oil and gas prices. We see a split. Insiders are their favorite area in the energy space is the oil and transportation industry, which is essentially pipelines, which do tend to provide dividend yields. So that's one of the strongest areas, if not the strongest area in the market for insiders in the United States. But they also like the oil and exploration space, and that's actually the second most popular area in the market for insiders right now. But that's a completely different story. That's a contrarian story. That's because that space is underperformed now for some time, and insiders are signaling there are some value opportunities there. But you have to be a contrarian investor to like that, and you have to be willing to, buy stocks that are weak and maybe go down a bit further, but on the assumption that cash flow is going to strengthen, or that the market is underpricing the cash flow. So we've got two very separate developments in the energy sector in terms of what insiders are doing, and it couldn't be more stark between the high yields, relatively high yields of the pipeline area, and then the potential growth area of oil and exploration. Insiders seem to be betting that the worst is over in terms of the oil price situation and the business models in the U.S. for the most part. are intact. Now, there'll be exceptions. Yeah, this is a general comment. It doesn't apply to every single stock in the energy sector. You have to be very selective in terms of which exploration and production company you'd be looking at. As with any stock, you have to be selective in terms of the fundamentals. So, that's a very interesting split, and we also see that split happening in the financials, which is one of the other few areas in the market where insiders are not overly negative on. They're not that upbeat about it, but let's just call it sort of fair value territory where over time you should probably expect a decent return, but not a great return. You've got a split. You've got bank insiders, relatively, I would say, constructive on the space. They're not banging the drum, but they're still positive on balance that you can, that stocks are at least fair value. And then you've got REIT insiders, which are also saying the same thing, that these two stock groups move quite differently depending on how interest rates go. If interest rates rise in the bond market, banks are going to benefit and REITs will not. If interest rates fall, it's the other way around. So essentially, insiders are giving you a hedge signal saying things could probably go either way, and it's not clear, at this point, over the next year, what of those two groups is going to outperform, if any of them do, or which one would outperform the other. We could be in a case for the next 12 months where, banks rally for a month or two and then they pull back and then the REITs rally. I mean, we could be in that kind of a situation. So no clear trends based off of interest rate signals in the financial sectors from insiders. I wish there was something more, concrete I could tell your listeners, but I mean, the fact that insiders are hedging their bets, I think is important, to understand that we're in kind of a state of flux here, based off of insider signals with respect to the direction of interest rates and how that's going to impact the U.S. stocks going forward.
We'll have more with Ted Dixon right after the break.
I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Ted Dixon. Ted, do you think Donald Trump will be able to pull off his plan to lower taxes in the U.S.?
Well, I think that's one reason why insiders in the U.S. are not buying the market, even on the dips. I think there's a lot of uncertainty with respect to the timing and the extent of tax reform in the U.S. And, insiders are basically saying, show me the money in the U.S. And I think investors should be taking the same approach. We still hear a lot of positive spin from fund managers on business television networks, that this is coming, but we haven't seen even a proposal yet. And so and there's some big issues with respect to how deep these tax cuts can be, given that Obamacare has not been repealed, and because Obamacare has a lot of taxes embedded in it, and also, if you get rid of it, you can save a lot of money for other tax cuts. So we've talked about that in the past, and there's nothing new to report. And, this could go on for months. And, instead we're getting a lot of attention focused on geopolitical events. We can only hope that the Trump administration is able to recalibrate here and get some momentum going. Meanwhile, the insiders are basically saying, be careful, and you're back to this game of being dependent on central banks. So every central bank meeting again is going to take on big significance until the Trump administration shows its hand. And this is like just back to the Hillary Clinton days right now. We can only hope that we're in a state of suspended Hillary animation here, but that's what that seems to be what we're confronted with.
It seems Trump had lots of ideas during his election campaign, but no thought was put into them. And all the job vacancies, they still don't have an ambassador to Germany. Half their diplomatic positions are unfilled. Everybody was fired. There's no continuity between governments now, and it seems that he has a flavor of the day. Yesterday he was talking tough about Canadian dairy. Should that be a concern to Canada, or is today or tomorrow he'll be thinking about North Korea, and the day after that somebody's hair color?
Well, this is a big problem that I think they're finding out, not having people in place, because it's very hard, for example, to really get a good tax reform package if you only have a few generals commanding an army of soldiers that only has you only have a platoon when you really need a number of divisions. And believe me, to move tax reform through the two houses of Congress, you're going to need an army of specialists and top-notch officials in the Treasury and to deal with the complexity of the trade-offs that are involved. So they're not equipped, and they're not equipped on the geopolitical front either. I mean, we had this bizarre situation of no one really knowing where this aircraft carrier was it heading to North Korea, or was it stuck in the Indian Ocean? And this is again a symptom of, as you said, not having the people in place. So right now the market is very vulnerable to news and central banks. It's the same story we had under Hillary Clinton. That's the reality. That's where we're at. There was a honeymoon period that the market provided Donald Trump. That honeymoon is essentially over. Doesn't mean the market can't go up, because it kept going up under the Obama Hillary years, and there's no reason why if the central bank now just sits down and on its hands and doesn't raise rates anymore and doesn't touch its balance sheet, you could still see the market float up, but that's not a prediction. It's just a possibility. You could also see it kind of languish here and sink. I mean, we don't know, because this is still, Jim, this is uncharted territory. We're still in that. The Fed has not finished its normalizing of interest rates, and what I mean by that, I mean they're still not to the point where you've got interest rates at a level that would be neutral based off of a growing economy. The U.S. economy is growing. It's going to be weaker than people had expected in the first quarter, but it's not yet in a recession at this point. It's growing, and interest rates, the case for interest rates being where they are is not very strong. It's the same in Canada, except we have a central bank that refuses to normalize because the only thing that I can conclude is they want to drive the loonie down under 70 cents. So we have this world of central bankism. It's still alive. We're hoping, like everyone, I think, in the markets, that the Trump administration is able to shake us loose from this period, this awful period of artificially inflated asset prices. But so far, we've yet to see the goods.
We'll have more with Ted Dixon right after this.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Welcome back. We're chatting with Ted Dixon. Ted, it seems like the Trump government is totally reactionary. They react to things, but they have no long-term plans. What does that do to Canada? Because our economy depends so much on doing business with the U.S. and having some predictability about it.
Well, it keeps our prime minister and his cabinet and our bureaucrats in the foreign affairs ministry very busy. And so far they've been doing a pretty good job. I didn't particularly like the response of our ambassador to Trump's dairy claims that Canadian farmers are hurting U.S. producers. That is likely not true. There's other global factors. The Canadian ambassador is right about that. He's absolutely right. I mean, Canada is not, because by definition we limit the supply of milk. We're not adding to the glut of world milk, but we do have a protectionist system in place. And I didn't appreciate his comments that the government is continuing to back that system because, why should one group in the agricultural sector get special protection when other groups in that sector don't and other groups in the economy don't? But in any event, this will all play out over the next few months and years as we tackle these trade issues. So, from that perspective, if we can finally reform supply management in Canada, Canadian consumers could actually benefit from what the Trump administration is doing. I mean, Alberta is going to benefit, if Keystone gets built. So there are some positive developments that are coming out of the Trump administration for Canada, but, there are big risks. Let's not kid ourselves. We still don't know what they have up their sleeve in terms of trade taxes. And, will there be trade taxes? We don't know. I doubt it, but, who knows? I mean, who knows? We just don't know. And until we see them show their hand, it's gonna keep everyone busy. And, but generally, I think the government's done a pretty good job, the Canadian government, in being on top of this. And, let's just hope, they stay on their game. It's gonna turn out to be, I think, a fairly long game. There's certainly no excuse for not being ready. I mean, this is being drawn out now a bit longer than people had expected. Gives our side a lot more time to get our ducks in order and our priorities set. And so, if we blow it, it's in our own making. But so far, I'm pretty optimistic with respect to how Canada should fare in all this. I think the Trudeau administration is doing a pretty good job handling it. I mean, they've taken a bipartisan approach. They brought Brian Mulroney in. Sometimes you have to put partisanship aside and you have to do what's right for the country. And I think they've done that for the most part on the trade. So let's hope they can stick with their game plan and hope it keeps working for them.
With uncertainty in the market, are we going to see the typical sell in May and go away?
Well, we very much could. Again, depending on the headlines, if Trump is able to bring some major tax news to the market, that could all change. But short of that, we'll be facing those types of questions, the overhang. So, Jim, for your listeners and those who visit CanadianInsider.com, I'm going to put our U.S. report on CanadianInsider.com on Thursday, on April 20th. We'll have our own celebration of this will be for insider reports as opposed to anything else. But that'll be, people will be able to download that for free on CanadianInsider.com. And we do talk about one area in the market where insiders are seeming a little bit upbeat on that's a bit surprising. So you can go download that report, and it'll be on our website on Thursday, April 20th.
And of course, with this being 420, how are marijuana stocks doing so far?
Well, they were on a bit of a rough ride after the announcement of the legalization framework, and I think the reason for that is the government didn't allow, or I shouldn't say didn't allow, they didn't explain what will happen on branding per se, and what they did talk about wasn't that great for product differentiation. They put all these limits on how you cannot brand your marijuana crop. So from that perspective, it didn't allow any company to differentiate itself. And then the big elephant in the room is going to be the supply equation. How the government is selling this is that they're telling Canadians, look, we're going to have so much marijuana supply ready when we legalize this that it's going to drive the criminals out of the market. Okay? The black market, the criminals being black market suppliers. So if you have a license to grow marijuana, you won't be a criminal, but if you don't have one, you will be. So I assume, unless they change that, but I haven't seen anything on that. But they want to move the black market out, which means they have to boost supply. I don't think it's clear now how this supply equation is going to work out for marijuana growers, publicly listed marijuana growers in Canada. Usually more supply means more pressure, more competition. More competition usually depresses profit margins. So you could be faced with, a very competitive framework. On the other hand, we don't know. Maybe the licensing requirements will be so strict that only a few players will emerge to be able to get those licenses. In that case, you might have one or two players dominate the industry, which will allow them to extract greater profits from the industry. So we don't know. So I think that's one reason why marijuana stocks sold off after the tabling of the legislation. And then, of course, there's this whole issue of being able to get the provinces on board, and we'll see if they're able to meet their 2018 target for doing this legislation. I think it's going to be tough.
One thing I haven't seen from either Ottawa or the provinces is the anticipation of tax revenue for marijuana.
Well, this is the other elephant in the room. There's two. Okay. There's a supply, and then there's this other elephant that's just come in, and it's called a tax elephant. And, the government will want to get its share of the profits of the industry, and they won't want to tax it so much that it allows the black market to come in. But they have their eyes on that. So that's going to take out some of the profits from the industry from the marijuana stock players. But we don't know yet. So with this kind of uncertainty, I think investors who have made some money in the marijuana space are probably wise to take some of that off the table. But, depending on how it shakes out, you could get another move up here, particularly, as I said, if it looks like there's going to be one or two major players that are able to dominate the space. But we're a long way from knowing that.
Ted, thank you so much for chatting with us.
Thanks very much, Jim.
My guest has been Ted Dixon, CEO and co-founder of inkresearch.ca, his website, CanadianInsider.com. You're listening to HowStreet.com radio. If you have any questions for us or our guests, you can email us at info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.